Good morning, guys. Good morning. I hope you're all well. Looking forward to the week. Let's just have a look back at what happened on Friday. Obviously, very interesting session indeed. I've got my four asset classes here. We've got the S&P top left. We've got the euro dollar top right. We've then got the Bund and Bund's bottom left, and then we've got crude oil bottom right. So it's a pretty interesting set of charts, this. Now, if we look at the S&P here, I'm just going to zoom in on this one. What a phenomenal end to the week. Thursday's session up 1.29%. Friday's session up 1.53% to close out a positive week, which seemed just, I mean, the chart, if you'd have asked somebody on February the 3rd, Monday, the first session of last week, if you asked somebody at the end of that session when the market dumped 2.46% to set a new multi-month low, if you'd have asked anybody, do you think the S&P is going to finish up on the week, they would have laughed in your face. And yet the unthinkable happened. If we look at the weekly chart, I mean, what an extraordinary candle on this chart. It's just amazing. After that big move to the downside, we bottomed out on that first session last week at 1732, and we closed right on the high at 1794. I mean, that is a 62-point reversal to close out a remarkable week. So, what drove the move? And here's the just quite bizarre thing. You'd have looked at this and said, well, if you didn't know any better, and let's say you were ill on Friday, and you're coming to your desk this morning having not known what happened, you'd have expected the payrolls number, well, it must be, surely the payrolls number was 350,000 or something to generate an end to the week like that. But of course, you'd have been exactly wrong. Here's the payrolls chart. So, 113,000 jobs were created in the month of January, according to the US government, which is pathetic. That goes alongside the 75,000 jobs created in the month of December. So here we are with, in fact, over the last 2 months, the average here for the last 2 months is below 100,000. That is not enough job creation to continue the economic momentum story that we've been hoping for in 2014. So why has the market reacted in the way it has to this information then? If we go back to the S&P chart, clearly a very positive move in stocks to say the least. If we have a look at other markets, look here on the right-hand side, we're looking at the euro dollar, so we've actually got dollar weakness. We're right up on the top side of this trend channel now, by the way. So dollar weakness, certainly against the euro at least. If you look here over in the bottom left-hand corner, well, actually, the Bund had an up day, so bond markets benefited as well, and certainly T-notes closed higher. And then if you look at crude oil, well, actually crude oil drove up and traded through $100 for the first time since the start of the year. In fact, sorry, that's the first time this year that crude has traded above $100. Yeah, that is right. So it's the first time this year crude's been above $100. So basically everything went up. Gold finished up on the day. I mean, literally everything went up. So how is that possible? Well, there's a couple of arguments. The first one's not a very good one, and I don't agree with it, and that is that the data's so bad that the Fed may well halt tapering. Okay? So this is one argument that you could say is positive for assets like equities. You could say that is also negative for the dollar, of course, because now there's going to be more. The money supply will increase by more than we had thought. And so that's negative for the dollar. Okay, you'd also say that actually this is good news for bonds, like T-notes, for example, because now the Fed are going to be buying more treasuries. And then you could argue that for crude oil, this is also positive because the dollar's weakening, and maybe it'll promote economic growth. So looking at these chart reactions and using that reason for the movement seems to work. Except I don't believe it for a second. I don't believe the Fed are going to stop tapering. I just don't think it'll happen. And actually, the big event this week will be tomorrow at 3 p.m. when Janet Yellen delivers her first biannual testimony. This is where she's going to speak. She'll speak on Tuesday and on Thursday. She'll speak in the Senate. And it's the first time we're going to hear from her. And you know, what message is she going to deliver, and how is she going to manage our expectations when it comes to tapering and when it comes to forward guidance? We'll talk about that a bit more in a minute. But you know, this is the big event of the week for Janet Yellen. But I don't think tapering's stopping. So I don't think this is really the reason for the markets behaving the way they did. Let me show you the second potential reason for the market movement that we saw. So this is the labour force participation rate chart, which has generally been in decline. Well, actually, let me show you. I mean, this is a long-term decline we've got here. Like, you go all the way back over the last decade, and generally, I guess it was flat, if you like, around 66% in 04, 05, 06, 07, and then most of 08, and then we started the decline. It's been in decline for the last decade, but definitely a large acceleration to this decline through the crisis. A decline that's been very consistent, okay? And here we are down at 63%. If we zoom back in again, what happened on Friday was actually the labour force participation rate went up. So actually in January, the labour force participation rate went back up to 63, which it did if you go back to November's data as well, by the way. It's not like we've never had the labour force participation rate going up. We had it earlier in 2013. So the May data showed an increase, and then the July data showed a further increase. So I don't think this is necessarily that remarkable, but the important thing about Friday was that the labour force participation rate went up and the unemployment rate went down at the same time. Now, this is the important thing. So the labour force participation rate went up, and the thing about that is that actually people were expecting the opposite. People were expecting the opposite, and that's because there was an expiration of some of the benefits expired. So basically, this affected about 1.3 million people. So in January, what happened was that job seekers allowance, one of the benefits, expired. So that meant that 1.3 million people previously were receiving benefit, but there was the part of the deal to get that benefit was that you were actively seeking work, and so therefore you were part of the labour force, but you were unemployed. Okay, so the deal was you had to be looking for work to get this benefit. So the idea was that once this benefit expired, all these 1.3 million people would say, well, sorry, I'm not going to, why should I look for work now? And therefore drop out of the labour force participation rate calculation. So the thought process was that actually, because of this expiration, that labour force participation rate would drop, and actually quite substantially. And in fact, the opposite happened, it went up, okay? So it's kind of defied gravity, this reading. Now, this is being seen as very positive. If you look at the household employment, now this is a separate measurement. The government does this from like the corporate side, but also there is a measurement from the household side in terms of employment. And here you get a massive divergence. So in December and January, the payrolls number was 75,000 and 113,000 respectively. But if you look at the household employment, actually that went up, in December went up 143,000, and then in January, and check this out, in January apparently it went up 638,000. So you're getting wildly different measures of labour force health depending on how you're looking at it. And I think ultimately what's led to, or certainly what's helped with that strong positive reaction to the payrolls number on Friday wasn't actually the payrolls number. It's actually looking at the labour force participation rate, the fact that went up, and it's actually looking at how the unemployment rate still dropped. And that's because very strong showing from the household employment side. Also, in terms of the weather, we had the idea that the weather has played a negative role in all of this. That was discredited on Friday, because actually one of the strongest parts of the payrolls figure on Friday was the construction. Construction saw 48,000 jobs created in January. So actually, well, not far off half of that total payrolls number came from construction. That's the sector that is most affected by weather. So the argument that's been thrown out there over the last sort of 5-6 weeks about the weather really playing a very negative role on job creation was discredited on Friday, but it didn't matter, it seemed. So you got a real confused picture. That's the bottom line.